So I have a couple economic updates for September 2024. Effectively, the Fed cut its rates, just like I said, between 1.25%. They went 0.5%. They're now in the 4.75% to 5% Fed funds rate. Say in November, they're going to meet again, and also in December. For November, they're thinking about, it's about 1/4 to 0.5% interest rate cut is very likely. December, probably another interest rate cut. We have to see how that goes. Jerome Powell is the Fed. Effectively, he needs to make a decision with the other people in the Fed. Do they start cutting interest rates? Do they start money printing? That sort of thing. Because the economy is starting to slow down, they think they might hit a recession, so they have to get that out of the way. So what they can do is they can start cutting interest rates today, and about 12 to 18 months later, those rate cuts are going to start impacting the economy and start stimulating it in some way. The problem is, generally at this point, you have about 6 to 18 months before you hit a recession. So what you're trying to do is speed up before you hit the recession, and you got to get the recession out of the way. So if you keep the economy rolling, it's not a big deal. But if you wait too long to cut rates until things look bad, it's already too late. So the Fed has a dual mandate. That dual mandate is you want maximum employment and you want stable prices. There's no specific number, but typically, historically, you're in about 3 to 6% for unemployment rate. We're a little over 4% and climbing. And the target is about 2% for stable prices. So what we have now is the 12-month inflation is now coming down to 2.5%. They think that we're going to start hitting about 2%. So they don't need to worry about inflation right now. GDP is still growing. It's at 3% in the second quarter of 2024. They did revise the first and second quarter of 2022. It did have 2 consecutive quarters of negative GDP. So it was a technical recession, but now they changed the numbers, so it's not a technical recession. Whatever. Initial unemployment claims for the last week is 218,000 people that went unemployed. That, just put it in perspective, that's actually one of the lower numbers that it's been since May of 2024. So that's not a huge concern. I also want to mention that stock market is not the economy. The economy is kind of like what's going on today. The stock market is actually how people feel and how people think earnings will be for companies, not today, but in the future. There's many times where the stock market can move up when the economy is not doing so well. But overall, if you look at GDP and current information, stock market looks great, economy looks okay. There's a bit of concern. Again, it's not anything crashing today. There are many indicators such as the yield curve inversion, the unemployment rate overall going up, manufacturing and things like that going down. So those are indications that we may be entering a recession. Again, it's not today, it's not tomorrow, it's not next month, it's probably not in 2024. If it does occur, it's probably sometime, I would say, mid-2025 if I had a guess. So that's why the Fed is starting to cut rates today. They're seeing those same economic issues, and they're trying to cut rates early enough that they impact the economy, start stimulating the economy, and avoid that recession. Now, other thing to note, China, the world's second economy, guess what? They're having issues with their growth. The People's Bank of China has now reduced the down payments to 15% when you get a loan for basically property. And the reserve requirement ratio has now been lowered by another 0.5%. That frees up 1 trillion won, or about $142 billion to go to be invested into real estate or whatever those loans might be. So effectively, this is providing more credit to the Chinese economy, and more credit is more purchasing power, which is kind of the equivalent of money, but you have to pay it back. So by them creating credit, people can buy more stuff that can prop the economy up. So China has a target for GDP growth. It's 5%. They're below that target, so that's why they're taking these actions to basically stimulate their economy because it's been slowing down. If you find this useful, I cover a lot of financial topics such as how to make more money, how to save, and how to invest. If you're interested, please subscribe and have a great day. Thanks for watching.